financialization. It will be introduced by Mr. Samir Shah, the co-founder of ValueQuest.
Hi, good afternoon and welcome to everyone to the second session. What I'm going to talk about is the theme which we are most invested in. This is our, kind of biggest position. So money is where our mouth is. So it was a global party. Somebody came out with a meme coin called Dogecoin, and people went frenetic. It went to a peak of $88 billion market cap. Or people were buying properties in metaverse, and then they were buying art for their properties in metaverse worth $69 million and whatnot. And trillions of dollars were being spoken about, so freely. So we were in heady times, and the reason for that is for a very long period of time, interest rates have been kept low, and maybe there is a generation who doesn't know what high interest rates scenario looks like. So people in the West have been used to 40 years of declining interest rates. Policy rates post-global financial crisis have been kept very low for a long period of time. And this has been, kind of the toolkit for all policymakers across the world. You have a problem, very simple, declining. You have to reduce interest rates, you have to pump in liquidity, and the problem will be solved. And, this continued. We had COVID, and guess what? This was the toolkit that was used. The injection of liquidity in the system made people heady because you had so much money in the system. Economy was not growing so much. So what do you do with the money? It went into inflating assets. The can kept being kicked down the road. Global debt today is about $300 trillion. $50 trillion of that has come in the last 3 years. This is post-COVID. And what has it done? This $50 trillion has added $17 trillion of GDP. So you took $4 of debt to generate $1 of GDP. And debt kept piling. People were not worried about it because they have not seen interest rates going up. So much so that a lot of money, and at peak it was $18 trillion, was into negative yielding assets. So that was the kind of madness that was going on. And as it happens, the clock struck 12. The world had its Cinderella moment, and all this inflation has come to roost. Initial response, as always has been, is that this is transient inflation, and it'll go down, and Fed should cut rates or whatever. So the policy response was a bit slower than expected, but yeah, it is very clear, and it's a very long-term regime which is changing. It is bound to hurt. There is going to be a lot of problems that especially the West needs to encounter. We are moving from inflationary boom to inflationary bust. And yeah, it was the elephant in the room. And you could no longer kick the can down the road. So policymakers have sprung into action. Massive interest rate hikes have been done. So from close to zero interest rates, most of the Western countries have raised rates between 400 and 500 bips in a short period of 1 year. And as expected, accidents have started. So we have seen this chart last week. This was the most popular chart last week. The mark-to-market losses on treasury that banks were owning is about $600 billion. And this was very high for a lot of banks to, kind of service. There are at least 4 banks in the US, or maybe 5, 6, where their entire net worth has been wiped out by the mark-to-market losses. Yeah, and in the age of social media, Peter Thiel told investors on 8th of March that they should withdraw money and there is some problem in SVB. 10th of March, SVB declared bankruptcy. So that is, as we all know, when the tide turns, that is when you know who is swimming naked. And we are not seeing, we've not seen the end of it. The interest rate hike, the enormity of it has still not sunk in. This is a simplistic calculation. Global debt start 2020 was $260 trillion. It is close to $310 trillion. Interest payments were $3 trillion, which will go to $9 trillion. This is globally. Some of the mortgages, etc., you are going to see people whose EMIs are going to go up between 3 and 5x. It is massive. And I don't know how many are going to be able to service it. And these are the internals. Corporate debt to GDP is very high. And within that, triple B rated has gone from 32% to 50%. And this was triple B rated before. We know rating agencies are behind the curve, and we are going to see downgrades. And what is going to happen to this debt, we don't know. There are a lot of zombie companies who will not be able to service their interest payments from their revenues. Forget the expense. Global wealth has eroded. Cryptocurrency from the peak of $3 trillion market cap, if we are to combine the market cap of all the cryptos, from $3 trillion, it's down to $1 trillion. So, all the losses are also going to be in trillions of dollars, and there is going to be a negative wealth effect that the world will see. There is no doubt that the world has to slow down. Real estate related stress, real estate forms 30, 40, 50% of lot of Western economies, and interest rate hikes are going to hurt both growth as well as asset quality for the banks. As far as emerging markets are concerned, we know the India of the past, where we were dependent on foreign flows and what all we had to do in this kind of a global scenario to attract foreign money. India is relatively safer, but we've seen a lot of companies or countries, not companies, going down under. So, world is basically grappling with a lot of uncertainties. And let's contrast it to the post-global financial crisis situation in India. So we obviously did not follow the same toolkit. Indian and kudos to the RBI and the government to not get swayed away. I know, post-COVID also, there was so much hue and cry about, no stimulus. Indian regulators chose to do supply-side reforms, and that is where India is really standing in good stead. So in the last 12 years or so, we had a big asset quality cleanup. We know what PSU bank balance sheets look like. Provision norms have been tightened. We had to deal with the NBFC crisis. You had Yes Bank and all going belly up. Demonetization threw up its own challenges. GST brought a lot of challenges. COVID crisis, and now war. And all these challenges have really been tackled very well. And this is how it looks. Banking system balance sheets have never looked so good. Capital adequacies are good. ROEs have started looking good. And asset quality. This is probably the first year where bank interactions, and Sanjay ji is here, he can validate it. Nobody is asking management's questions on asset quality. Zero questions. I mean, that's how clean the books are. Madhu ji was here. I think he used to say कि वो बाजू वाले का भी NPA दिखा दिया है. So that's how much recognition has happened. India, the corporates have also deleveraged. We know the super success of the largest corporate, Reliance Industries. How there were concerns during COVID time about corporate leverage, and how India has been able to deleverage. So we have been in a completely different cycle to the world. We have gone from whatever troubles we faced to where we are. So obviously people were conservative. Actually, India's debt to GDP has gone down, one of the only few countries to do that. Headline inflation. RBI target of 4% inflation plus or minus 2% has been sacrosanct, and they have always taken measures to contain inflation while supporting growth. Especially, how wrong we were when Shaktikanta Das came in. Everybody was saying that, this is a bureaucrat who is being brought into the RBI, and, now he will do what the government wants him to do, and there will be... And what has turned out is exactly the opposite. He won the Governor of the Year this year. So headline inflation has been controlled, which is why our central banks have, their hands have not been forced into raising interest rates like the others. So if you see India, cumulative rate increases is 2.25%, which is less than half of what the developed world has seen. So both, we are not feeling the pain anywhere close to what the world is facing right now. And that is, we have to thank the regulators for it. Within the banking system, the quality of earnings have dramatically improved. I think last few years, we have seen every bank worth its salt moving to retail lending and mastering their retail lending franchisee. And there have been a lot of initiatives which have helped in terms of maintaining the asset quality. So, this is again another concern that if world slows, what will happen to India? So obviously, if world slows, we are not totally isolated. We are going to have our impact. But even in slow growth years, world has always seen oasis. These are just two examples where, between 61 and 95, 33 years where world grew slowly, but Japan and Korea were much ahead in terms of growth. Similarly, 94 to 2013, when the world was growing slower, India and China. China obviously has grown leaps and bounds in this period. Uh, as the adage goes, "Apna time aayega." I mean, this time is India. So India is well poised. We have 33 crore gods, and God is smiling on us. Oil prices have also gone down, and that is going to dramatically help current account deficit. So the confluence of factors for India, India is truly the oasis in the world, and if we can manage this well, we are going to change trajectory. So when we did, you slice and dice whatever data you want to do in whichever way you want to do. Remove the names of the countries. The balance sheets of the Western countries or the global powers is more looking like emerging markets and vice versa. India is considered emerging market, but our balance sheet is more looking like a developed market. Our currency has been reasonably strong, and that is throwing up a lot of wealth creation opportunities as we see it. So Ravi spoke about this Z function and S function. This value migration has been going on. It is the most secular theme within financials, which is value migration from public to private. It is kind of a stealth privatization that has been happening with public sector banks losing share and private sector banks gaining share. So in terms of profit, private sector bank profits are already above public sector bank profits. Whether it is liabilities, whether it is assets, you take again any parameter, the market share or the value migration is happening from public to private. And that is one big secular driver. Second is this financialization of savings. So Indians have been great savers, though the saving rates have gone down. But within that, so we would have gone down from 35 to 30, but within the 30%, the share of financial savings is much more than the physical savings. So the love for gold, the love for real estate obviously will not go away. There are many women in the audience, so we can never wish that away. But still, people are discovering financial savings, and regulations have really helped. UPI is a classic case. The kind of explosion that UPI has seen and the kind of adoption that we have seen is truly remarkable. We have seen this with Jam Trinity, when so many accounts got opened. We saw that with so many demat accounts getting opened post-COVID. So, and there are many more. There is OCAN, there is account aggregator framework. So Mr. Saurabh Tripathi is going to speak about that in detail. Regulators, whether it is IRDA, whether it is RBI, they have been pushing for this penetration, inclusion. And that J curve is clearly visible. Indian economy is getting more and more and more formalized. And for us as equity shareholders, what does it take to create wealth, or to within, how do we take advantage of these trends? So basically, we look to identify the banks or financial institutions which have the product, process, and the people. I mean, that is That is what. It's a service industry. It's a business of trust. So, and it's a leverage business. So it cuts both ways. Very few banks are able to create tremendous wealth. One such example is AU. Uh, we looked at this company as a pre-IPO when it came to the table, and it was a teaser, just a 4-slide presentation. And believe me, the eyes couldn't believe what they saw. It was too good to be true. For a company of that size, of what they were doing, it is truly phenomenal. The pre-IPO happened somewhere in 2017 at 5,000 crore valuation. AU today is 40,000 crore market cap. Profits have grown from 60 crores to 1400 crores in a decade and counting. And this is just the beginning, and you are going to hear one of the best entrepreneurs India has. And for sure, after a decade, we are going to, he is going to be different level. It took 13 years to go to first 20,000 crore loan book. It took another 3 years to double it, and another 20,000 just in 1.5 years. So a truly remarkable journey, and it is as exciting as it was in 2017 when we first invested in AU. So Jim Barksdale, founder of Netscape, he famously said that the only way to make money is by bundling and unbundling. And within, it couldn't be truer for financial services, where a lot of wealth creation has happened by unbundling. So maybe earlier you had a Bank of America who used to do everything, and now there are so many fintechs who are doing specialized uh, business and giving what the customer wants and taking away. You see the number of customers Paytm has. It is multiple of what the number of customers the largest bank in India has. So a couple of them have gotten listed in India as well. And there are going to be wealth creation opportunities in that space too. In the nutshell, this is what we would say. Growth is back. This is just last 1 year. You can see clearly from left to right that we are going from red to green. All the banks in the country are growing, and future looks bright. This is purely been driven by retail lending. The Indian manufacturing story is going to play out in the next decade, and the growth rates of next decade are going to be way higher than the last decade. Truly Goldilocks scenario. Thank you. That's